Okay, hello traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, June 3rd. Good to be with you guys here. DJ, Marcin, everyone in the room. I apologize about Tuesday's webinar. Something came up and I couldn't make it on board, but we are back. And it's been kind of a boring week, I'm not going to lie. In FX specifically, a lot of ranges, a lot of crunch, at really critical levels though, right? You've seen ridiculous moves. Obviously, I noted yesterday in AMC and all these other trades, but FX has kind of been doing its own thing. Now we're heading into major event risk tomorrow. And typically, NFPs have kind of been a, not the most severe release, but in this environment where we are, and on the back of last month's massive miss, right? Last month we got 600, we got 266 versus a million. So the expectation for tomorrow on non-farm payrolls is 650,000. Unemployment is expected to downtick from 6.1 to 5.9. The caveat there is going to continue to be, as it always has, guys. I always tell you to look at the participation rate. The market labor force participation rate did uptick to 61.7 last month. So we do want to see what movements there attribute to that larger move in the unemployment rate. At the same time, we're getting the release of Canada employment. I always tell you these Fridays tend to be very big, especially because of where we are in time. Also, remember this last month of the quarter, CAD employment is expected to show a contraction of 20,000 as unemployment upticks to 8.2. Obviously, dollar CAD, the trade we'll be looking at later today, that's at a critical juncture as well, really just hugging major key support in a consolidation pattern. So while the volatility hasn't been there, there are a lot of setups to review. So on the menu for today, we'll hit DXY, Euro, Sterling, Dollar CAD, Aussie, Swissy, Gold, Crude, Dollar Yen, actually with a move here, SPX, and Bitcoin continues to hold that major key range. So it'll be interesting to see what we do on that. Marcin, I've been waiting for you. Where are you, brother? There it is. Sterling Kiwi, New Zealand dollar, Euro Kiwi, Swiss yen, really? And Sterling CAD. I got you, brother. No worries. All right, let's jump right in. So here's what the DXY looked like back last week. Here was my update on the 26th as we were closing out the month. This pitchfork ended up to be null and void because we actually made another drop again into the zone, and we've kind of been trading here ever since. So real quick to show you where we are, this is pretty much the only chart you've needed on the DXY over the last, 4 weeks. Yearly open support 89.93. We've been talking about that ever since the May drop. Zero weekly closes below, right? So we're still at support. Everyone's talking about dollar. Oh man, inflation is going to be dollar negative. Everyone keeps harping on the same stories. And I keep coming back to the chart and saying, God, we haven't broken support yet. We very well might. Okay, but we're at support. What do you do? There's nothing to do on the short side, in my opinion. I've been saying this all week long. We're at support. So at the end of the day, look at the 3-week range we've been in. It's just straddling the objective yearly open. Key resistance still right into the 91 handle. Here's what it looks like on the daily chart. So within the confines of this drop, it's sort of like an expansionary range. We could use the same parallel and kind of do something like this. Also kind of fits the slope still as well. But you could see essentially we're still within the confines of the broader decline, but the last, 10 days, 8 days have just been bobbling and a straddle of the yearly open, right? Here's the rebound. Need a break above 90.42 to get this thing going. Bearish invalidation, what would suggest full-on reversal? 91. 91. Interim support 89.68. Again, if we break the lows, and the low day close of the year actually was the exact low last month, guys, 89.53. That was the exact January low day close. So such clean technicals here. I just think we need to see a break. Momentum is completely flatlined. We're at the bottom end. We're heading towards the upper bound, but at the bottom end of a multi-week, multi-month descending formation, starting a new month. Here's the intraday, right? So here's what it looked like last week. We were working with that high, low, high. You can still, I was looking at this earlier today. I don't know, it might be too early to put emphasis or to put any credence to this, but it suggests support again, objective yearly open support, now bullish invalidation for the near term, a break of the objective weekly range highs here. You're looking for 90, 40. Again, that's on the median line. And then the upper parallel is at 618, 90, 82 into 91. So this slope does actually work well. I don't like gradients that are so sharp, right? I don't like the angle of attack or the gradient just to be that acute, but nonetheless it is, and we'll see if it holds. All things held constant, you're looking today for a reaction basically here, just a little higher, guys. You have the basic trend line resistance right off the highs right here. 1 touch, 2 touch, 3 touch, 4 touch. If you want to count that, we're right there. And then the median line for the formation we just drew a little bit higher. So this is sort of your breakout zone. This is also last week's high. So anything above 90, 42 near term, and you're looking for a rally towards 98. If we fail here, I don't necessarily need to wait for a break of the weekly range lows. Like I said, if we break below 89.93 again, 89.88, so the 618 of the weekly range last week, right here, that essentially for me at this point would be enough to spill the trade lower and look for the resumption of the bearish trade in the dollar. All right, so for the dollar, man, it's crunch time. We're looking for a real tight range break right here over the next 24 hours. NFP's on tap. Again, the expectations for a print of 650,000 jobs. We'll see how that pans out. Any questions on the dollar? Still just hobbling along objective yearly open support. That's DXY. Number 2, here's Euro. Is a very similar scenario. I don't have enough emphasis or I don't have enough touch points to really put credence on this descending slope formation, but I did want to just bring it up. Here's what Euro looked like earlier in the week. Right here. So I was working with a slope off the high low high from last week, right? We came back and probed that again. So all I did was move over those 2 reference points to this new high. Again, it's too early to put emphasis on this slope, but highlights near-term resistance at 122.20, filled right ahead of that last night. Highlights again, 2160 is near-term support. If we break lower, the lows converge right around 2130, 2140 on the median line. So it's a very similar scenario to what we're looking at with the DXY, right? Last week's high at slope, last week's low at slope. That's what you need to break to validate a larger turn in Euro. Now, all things held constant, you know, if we were to push beyond 121.60 today, in my humble opinion, that would be a confirmed break of the weekly opening range, right? Right below resistance. Typically a pretty decent play. You'd be looking for 21.32, and then the break there would really open up the larger pullback in the Euro for getting it. But we are at resistance. Reminder, here's Euro on the daily chart. We're going to go backwards on this one. The 618 extension off the low, the objective yearly open, February highs, all lined up right here at 2240, 2261. We've been talking about that since last month. We've seen 6 daily attempts to breach that, all fail. Here we are, February high day close again, very decent pivot in prices support. That's what we need to break to mark resumption for the next leg lower. Quick reminder again of where Euro is trading on the weekly charts. Man, we're at big resistance. A level that we highlighted, very tight range of 2211, 2218 is the 786 of the objective yearly range. The high week reversal close for the year, man, oh man, doesn't get much closer, much cleaner than that. Here's what it looks like on a close basis. Resistance. So I think some clarity is falling into the picture here as we get deeper into the month. Obviously, all the monthly opening ranges are still intact. We'll drop our monthly markers as we head into next week, but we're at resistance in Euro. We're at support in DXY. Where's Sterling? Here's British Pound number 3. I know Jamie's looking at a short here. I think we're at a very big level as well. We've been talking about this region right here at 40 to 36 into 43. So 60 pip, 55, 65 some odd pip range of resistance that is so critical. 50% retracement from the decline off the 2014 highs. 2018 high close. You have a very, very long list of spike lows, swing lows, pivots in price, all right here. It's the objective yearly high we made back in February. It's been 3 weeks. We haven't been able to break that. Momentum still on that divergent mark. This new high is still marking radical divergence with the previous highs, both levels under 70. That's typically a strong bearish divergence. Where does that lead us? Well, here's what the sterling looks like on the daily charts. We made an outside day reversal, okay, off the highs, and that's kind of what drew my attention to this. Right off the bat was that outside day reversal. Okay, that's the first time that we had highlighted this and said, uh-oh, red alert, this is exhaustion. And these are the exact exhaustion trades that you look for because they're at resistance, they're at uptrend resistance, there's divergence in momentum, and then you get an outside day reversal. Those are your conviction trades. So is the first position I dropped here on the first of the month as we were making that turn, set to look for a break of the high day close. And that's kind of what we've been looking for. We dropped right into it, probed below, but we're still holding that range. So here's the levels as they stand now. Nothing's changed. Okay, that was the level. We bobbled there, broke below, failed, rebounded, and then here's another rebound that failed at the weekly open. Here's your weekly open, essentially. Came right into it and failed again. Listen, we need a pivot below 41.38. Okay, we need an assertive close below that. We need a break that targeting 40.90 and key support right just above 40, the 40 handle, like 40.20 is where the lower parallel converges on the 38.2 retracement of the rally. So actually, I stand corrected. There's a new high here. I'm sorry about that. There we go. Stretch that zone just a little bit higher. 40.28. It's even better on slope. Okay. On this trade, bearish invalidations right at the weekly high, that 42.43 level that we've been talking about. Anything beyond that, and you're basically risking just the resumptive move for another 100 pips up. Don't want to get caught on the other side of that trade. But all things held constant, man, this thing is marking divergence into uptrend resistance. Really tired looking. That was a threat that threatened a break of the weekly opening range low, which failed. So I'm kind of a little more hesitant now. I'm a little more skeptical. But all things held constant, this thing is at pretty major resistance at the yearly highs, at weekly resistance. Questions on pound? So let me jump into pound Kiwi, Marcin, since you've been looking at pound Kiwi. Here's pound Kiwi on the weekly chart. Kind of a range special here. About 38.2 there. Yep. Okay. So right off the bat, jot down 97.16 to 98.30. That's kind of a pretty significant zone of resistance to 38.2 of the advance off last year's low, but it's also 38.2 of the recent dump off the highs in March. That's kind of been, holding the highs here ever since that dip. Keep your eyes on that. Let's see what the closer charts look like. Sterling key. Okay, so you can tell we put this formation on last week. You can see the median line caught support real nice. If this is a breakout, you kind of want to omit this, but at the same time, it's sort of a consolidation or a contractionary range just below resistance. So the same resistance zone that we've been talking about right here, that's where the contraction is happening into. You can see a series of higher low, higher low, higher low, higher low. Highs are just ramming into that resistance and holding. The high day close of the year, or the high close of the year, is 97.50. The 38.2 comes in at 97.60. So that's key resistance right now. Here's the intraday chart. Let me bring it out to the 4-hour. There was I guess we were looking at that last week, March, and here's the breakout. I wouldn't do anything in this. I wouldn't do anything in this until you reach 97.60 and try to get a play off that, to be honest with you. I don't like, well, excuse me, let me just take things back one step. If you put a pistol to my head, Marchin, I would say I'd be looking to fade a rally into that region. If what we're interpreting with sterling is correct and it is kind of peaking a little bit, my problem with it is Kiwi. Kiwi looked like it should have turned lower. I do like Aussie better than Kiwi, but Kiwi's kind of do its own thing. So I wouldn't be surprised, Marchin. Again, I'm not dodging the question, brother. My humble opinion. I wouldn't be surprised if this thing goes lateral for a couple more days. You got to see a 97.60 break on a close basis for the day to get the breakout. Otherwise, you're still in this contractionary range, I think. Not the cleanest setup. Hope that helps. What was the other sterling cross? Sterling CAD. So that was sterling Oz. And here's CAD. Yeah. You have some interesting taste in trades, March. And what here excites you? Sincerely, like what here excites you about this being a trade that may offer some sort of massive move? You've been in a 3-year sideways lateral motion. If you're just trying to play the interior levels, yeah, I guess you're heading towards support. You might get a good bounce. I would probably wait for a deeper, a deeper touch towards there to get it again. But not a trade that just interests me at all at this point. That's just a big turnoff. You haven't done anything in this for the last 3 years. Near term, I guess you could make the argument that you're coming off of trend support. So you may actually just look for a break of this multi-week range that we've been in, bearish invalidation at that 100-day moving average, or is that the 2? I think it's the 100-day, yep, like right here. Key support and the resumptive move, 169.50, 168.50 is where the break would happen. So range, but obviously the slope that we had added on last week didn't give you much. I wouldn't take it off just yet. If it fails at that 25% line, it still might drop lower again, but yeah, it's ugly. Marchin saying, ugly, ugly, I like ugly. Hey, again, I always tell you, I'm willing to look at any trade. There's opportunities that come in the most random pairs. I'm with you on that. But you don't want to try to force analysis or force a position or a directional bias on a trade that is not technically clear. And that's just where we are here on Sterling CAD. So I'll leave you with that. Speaking of Sterling CAD, what's up with dollar CAD? Here's what we're going on with Looney. I hope this thing absolutely rips higher. As a disclaimer, I don't have any positioning on it. I just think that everyone and their mother is uber bearish, whether they're looking at dollar weakness for justification, whether they're looking at crude strength should translate to CAD strength, and that means dollar CAD lower, whether it mean whatever the fundamental air quotes, right, reasons you want to put behind it. Price has been in contraction for the last 3 weeks, period. End of conversation, exclamation point, end of paragraph. Until that breaks, I'm not buying it. I'm not buying it. I'm not buying this whole like, oh, just position for dollar CAD in 110 and you'll be fine. No. We're still straddling a major critical support zone that we've been looking at even on the weekly charts. Here's dollar CAD. 2017 swing low, the 50% retracement, the entire advance off the 2011 lows. We're in deep oversold. We've been in oversold territory for 3 weeks. What do I always tell you guys? When the market is in oversold territory, when the oscillator is in oversold, that's when it has the most push, right? That's when there's the most thrust behind it. Well, for the last 3 weeks, we've still been holding support. Forget the intraday noise. There's the close. So what gives? I'll tell you what gives. We're at a major critical support structure, and despite the oversold reading and despite all the headlines, until this level breaks, dollar CAD is not just in free fall. Okay, we could have said that back in April. We could have said that even at the start of this month, even at the start of May rather. But ever since the 19th and the 18th, this whole region here, we've just been doing nothing. Now, today is poised. We haven't done it yet. Of course, US markets aren't even open yet. But if we do end up higher, today would be poised for an outside day reversal off the lows, off support. That would typically be a constructive reversal pattern. Just like we got an outside day reversal off resistance, shifted lower. Outside day reversal off resistance, shifted lower. If this turns out to be an outside day reversal off support, might be in for a little bit of a bounce. Now, again, even if that happens, you're still trading within the broader range of dollar CAD 2140s being kind of your resistance ceiling there. But dollar CAD specifically is really, really good with the outside day reversal trades. Again, never take my word for anything. Always look for markets to prove that. Here's, like I said, here's an outside day reversal. 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 You know what I'm saying? Like, dollar CAD abides by this well. So you want to pay attention to when you see these developments happen. Watch today's close. We would need to at least spike against that high and close above yesterday's open for this to be an outside day reversal, but something to consider. Now, what does that mean for the scalp, right? What does the broader picture mean for the scalp? Well, that's just been in consolidation, and that's the only thing I'm focused on right now for dollar CAD. So this is the 240. Here's the 120 as I've been showing you guys. Here's what the update looked like for Loonie. Okay, and this is what it looked like back yesterday. Just contraction, 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 contraction around that key region we've been talking about, 2048, 2061. So the range is set. Yesterday I told you the weekly opening range is low, essentially 120. It's the weekly opening range low. The weekly opening range high now converges essentially on that upper parallel, but really 2140, those weekly highs that we kind of touched, is what we need to at least validate a breakout of the range. And then it's 22 and 2247, 2254. That's the big player. I think anything above that, and you're talking about a larger scale reversal in dollar CAD. Way too early. It's all if-then statements. Right now, we're still in this godforsaken contractionary range. So until we get out of this, guys, stay nimble. Again, this is one tomorrow that may see increased volatility with the combination of Canada employment data and NFPs released at the same time, 8:30 Eastern. Keep an eye on this breakout for guidance. If today turns out to be an outside day reversal, it certainly would support the notion of a bigger jump there. Okay, that's dollar CAD number 6. Any questions on Loonie? Expected contraction, like I said, of 20,000 jobs next month. We'll see that released tomorrow morning. Unemployment is expected to uptick from 8.1 to 8.2. Aussie dollar. Well, this brings a smile to my face. I hope this starts to continue. We've been looking for the Aussie turn. You guys know from last week when we broke this multi-year trend support. I'll show you that in a moment. But here's what Aussie looks on the weekly chart. We'll just take a top-down approach here. The major resistance level, 78.36, 78.66, that's still been holding all year long. We got a big reversal candle off that. It broke, and we did technically close last week below basic channel support. 3 point, 4 point, that was the break last week. This week, the rally failed at former slope support resistance, and we're right back unchanged on the week. So we're literally putting in a weekly doji right now if we were to close. 77 is the yearly open. We'd be putting in a yearly doji right now if it was December. But just goes to show you how the Aussie range below resistance has been phenomenal all year long, guys. It's June and we're still trading in the same range. If the break of this upslope is legit, a buckle below 77 should get this thing going. We talked about the divergence that we noted all into the highs. Raised ceiling, turn right ahead of uptrend support, uptrend resistance. That reversal was an outside day reversal, outside week reversal off the highs. And ever since then, we've been trading in this tight range. Here's what the daily chart looks like. Last month's opening range never gave out. Here's your May open. You set a low and you set a high within the first 10 days of trade. We're still trading in that range. A series of lower highs, not really higher lows. Here we are. If the break of this formation, I'll remind you again on the daily chart, this is a pitchfork off of last year's low, a modified pitchfork, but look at that slope, right? Look at that slope. So was that a break? It broke, but then we fell into this key range. Support 77, bullish invalidation 76.70, resumption 78.25. That's what you need to break the upside to kind of put the longs back into play. But all things held constant, like I said, if this break of uptrend support was legit, today we're making a move back below the 100-day moving average. If we close below the yearly open, your last ditch effort is 76.68. Why? Not only is it a key Fibonacci ratio, it's the 618 of the April rally, but it's also, guys, the objective monthly range lows for May. So that's the crack that would really put Aussie in a much more bearish stance, much more aggressive bearish stance. And we would be looking for sort of initial drop at 618 comes in at like 76, essentially 75 90s. And then you're risking like 75 and below. So I'm really interested to see how we close out the week. Watch this key zone in Aussie on the downside. Here's what it looks like on the intraday chart. We've been following this downslope for the last couple of weeks. Here's what it looks like. This one was published back on the 2nd. No change. No change. We're testing support. We're testing the weekly open. We're testing the yearly open. We're testing the opening range lows for the week. Everything looks good on this. I'm loving it. I'm looking for 76.68 and see a reaction at the median line if we get it. Questions on Aussie. No Aussie data of interest really until not until later in the month, late next week. Is there a potential for a bounce above 78.20? Jamie, there's always a potential. I don't know. I can't answer that question for you. Anything could happen, right? Is it probable? In my humble opinion, no. So Jamie, if this break ends up being a break of the monthly opening range, or excuse me, the weekly opening range, inherently, that would have me looking for like a Thursday, Friday low. So, it could, Jamie, drop into like slope support and then rally up. I don't know, but what I do know is the current stance and the current positioning. So the purposes of this webinar, we try to stay as near term as possible. I see no reason for us to even look at a 78.20 clip unless there's some sort of mean reversion here, some sort of bounce off of key support. Just not happening. Make sense? All right, we need to get some follow through here. 76.70, essentially 76.68 needs to break. Like I said, that's last month's opening range low. That's this week's opening. Well, I mean, even the drop that we've made so far, it's just been the range lows for May that we never broke. So that's really where I think We look for some action here today if we're going to get it. That's Aussie, number 7. Number 8, Swissy. I just wanted to give you guys an update on this. It looks very interesting to me. As I told you yesterday, it's too early to put emphasis on this upslope. I don't know if it's in play yet because we haven't gotten enough inflections. But yesterday, it had me looking for the possibility of a low ahead of 89.68, specifically bullish invalidation down at that 786. We did drop a little bit lower, but we never actually got the tag. A reversal candle off there, and we're right back at the high. So the weekly opening range is preserved just below 90.30, which is resistance in last week's high. If we break there, you know what level we're looking at? Because the same level we've been looking at for 2 years, 90.80, 90.90. It's still the same key region, guys. Not a damn thing has changed. This has been such a major inflection point for dollar Swiss for years and years. If we break above 90.30, last week's high, a 618 retracement, downtrend resistance, uptrend resistance, I think that's where you get the accelerated pop. That's the level you need to break, though. Constructive above 89.68. Questions on Swissy? Number 8. All right, some gold action. Who's with me? Is Iman in the room today? I don't think I see her in the room today, but gold is poised. Gold is poised. Gold is poised, and I love it. The day is already panning out pretty strong. I'll remind you again what we've been talking about here in gold for the last 2 weeks, and that level has been 1909 to 1922. Why 1909 into 1922? Well, it's the high close for the record that we made back in 2012. You all remember that year, 2011. It was what, post-financial crisis. I was doing an expo in Vegas, I remember, in the good old days with FXCM, in front of like 2,500 people, and gold was ripping. We were talking about gold at 1,800 being like, oh my gosh, gold's gonna be $3,000 before. Well, that ended up being the high. The thing spilled lower for the next 4 years, and then here's the assault and the rally higher. This year's, or last year's decline was sort of the largest correction we've seen in gold since the advance off the 2015 low. And it had a lot of people scratching their heads and all this stuff going on. We bottomed at a very nice spot, 1682. Our last sort of objective level, we were looking for a low either at 1682 or 1650. Never got the 1650 clip, but here's the rebound. For the last 2 months, this thing's been ripping, and everyone's been talking about inflation, and all of these are supportive for gold. Absolutely, historically speaking, the inflationary hedge. Well, last week we put out a bulletin saying 1909, 1922 is absolutely paramount. This is the 618 retracement of the decline off of last year's high. Again, the high close from 2011. Uptrend resistance. This slope is all derived off of the basic origin slope. A parallel, resistance, resistance, kind of run-throughs here. Resistance, okay. Again, 1909, 1923. If in case that wasn't enough, pitchfork added here off the low, high, low. Median line break, acceleration. Median line, resistance. And here we are. Look where momentum peaked. Right around 60, just above. Right? Now, another one that's very important to look at into Friday, because if this one comes out to be an outside weekly reversal off the highs, I'd pay attention. Last time we saw an outside weekly reversal off the highs in gold was right here in January into this same zone, and that was the beginning of the whole drop down. Pay attention at the close of the week tomorrow. A breach above 1923 is what's needed to mark resumption. I do think gold is still in the uptrend. No one's hiding that. No one's changing that. No one's disputing that. But we are at uptrend resistance. Here's what it looks like on the daily chart. So we already made a break of the initial weekly opening range to the downside with this move. Here's the momentum oscillator that we've been tracking. On the daily chart, right? Finally broke from overbought conditions right past a basic trigger in momentum. That typically is a bearish signal. We dipped back below the objective yearly open. that typically is a bearish signal. Near-term support, first level of interest, 1876, and that's on tap right now. Here's what it looks like on the intraday chart from Monday, or I guess this was Sunday, or Tuesday rather, Monday night into Tuesday. Here was the weekly range, support at 1882. It was the first level we wanted to see a move at. The break below that, 236 takes it into 1860. Here's what it looks like on the intraday. So pretty clean. We're right there at the slope. I added this 100% extension because I wanted to see if we got a break there. I want to see this accelerate. If this is just corrected, we kind of look for slope. Okay, maybe 100%, last Friday's low. And if this rebounds here, kind of dissuade any of that reversal threat. My humble opinion is that we actually do see a break here. If it rallies, you need to see it hold at the yearly open. 1898 needs to be resistance on this initial stretch. Downside move, you're looking for 1860. There's no slope on this yet. We could, I was looking at this earlier today. I don't see enough justification just yet to kind of marry it, but it would put this a little bit closer in time. And it would suggest here that this break should be an acceleration. We should not see this kind of meander. If it's not going to move lower in the US Open, it's probably going to rebound. We'd need to see resistance at 1898. Any questions on gold? I mean, just big level, even on a weekly chart, big level, big resistance. Look for reaction here. Along with gold is an interesting breakout in crude prices. And here's what people have been looking at with crude. I've been pretty explicit on this. I hope you guys have been on board with this trade. Oil was, the major level that we talked about last week was 66.26, and a break and close above that would have kept the focus higher. We broke and close above it last week. Okay, we placed an outside weekly reversal. That's what this red candle was. Look at all the last times we made outside weekly reversals in crude. Were all pretty decent pullbacks. This one, false. False, right? The next week we just moved right higher and closed higher. So here's the breakout. On the weekly chart, 71.45 is the first level that comes up, and that is just the outside reversal candle. Well, it wasn't outside, but it was the reversal close candle back after those October 18 highs. So that's sort of the first level of interest. Here's oil on the daily chart. A little bit more confused, a little bit more concerning in that near term. You might see a little bit of a hesitancy, right? Here's the pitchfork. Resistance, support. What is that? Resistance? Well, at this point, if you see failure here today, we want to see constructive support above the monthly open, above the 2019 swing high, okay, above the 25% parallel. Topside breach from here, 70.95, and there's that 74.19 level. All things held constant. Again, we try to stay as objective as possible. How many signals are we getting that are actually confirming the bias that we're assuming? Well, here's your monthly open, monthly opening range, failure to break the monthly opening range lows, outside day reversal off the low, mind you, shifted the focus higher once we cleared the monthly opening range highs, going for the stretch. So yeah, I think the immediate stretch is tired. I do like the trade constructive above 66.57. Next upside target, 70.95. Here's what it looks like on the intraday chart. I have a little bit of a, I guess this is, let me show you the 4 hour just to get a little bit cleaner. This is the same slope you're looking at the daily chart. So you're seeing divergence, into upslope resistance. I wouldn't be surprised if we dip lower, or at least get a little bit of a pullback. Like I said, constructive above 66.15. Next upside target, 70.95. Questions on crude? All right. One more base on the FX cross before we move over. Here's dollar yen. It's been quite an interesting trade. I'll bring the 2 hour here just to show you. The weekly opening range is being challenged right now. My idea for dollar yen with you guys was, let's look for let's look for a move lower for a rebound. Ideally into the May open, ideally into a 38.2 of the advance. So I was kind of hoping for a drop right here. 109.20s, 109.25. We didn't get there. We dropped like 109.31 was the low. And then here's the opening range for the week, taking right back intact. If this is a breakout of the weekly opening range high of upslope resistance, the next upside level is 110.55. So again, as a disclaimer, I'm not currently in this. I was kind of hoping we'd get a little bit deeper of a pullback to get in. If the breakout is legit, like I said, acceleration should start to happen towards the end of the week here, and you're looking for 110.55 on the upside. The one thing to keep in mind is that dollar yen is very sensitive and tends to be very reactive to major US data. So keep your eye on yields tomorrow. Keep your eye on that NFP print and its effects on yields. If we take a look real quick at the US 10-year, we broke out of that downtrend that we were looking at last week, and we've just been bobbling aside. So I'm going to remove this for you just to show you what this thing looks like. And here's the daily chart. So we're not out of the woods yet, and there's major event risk tomorrow into the close of the beginning of the first week of June trade. Look for some guidance on a move here tomorrow. All right, so that's dollar yen. 1056 would be the next upside level if we close 109.90 today. Last but not least, two real quick touches. One on SPX. Here's what the SPOOS looks like heading into the open of Thursday trade. We're finally turning up that trend resistance. It's been surprisingly clean, to say the least, despite all the volatility you're seeing, and everyone's talking about AMC and all these crazy ripperoos and all these Discord chats and all whatnot. The technicals are actually pretty clean. The resistance zone that we talked about to the start of the week was 42.09 into 42.19. That's what you needed to close above to sort of validate the breakout and the resumptive move for SPX. Couldn't get it. There's the it sumped, and then again, 4-hour reversal, or 2-hour. It was a 4-hour too, but a 2-hour reversal candle right off the highs was resistance, Here's a break of the weekly range lows and the high day close for the year, which is still the maintained high day close for the year. Watch the close today. I'm specifically interested in seeing how we close up around this mark, 41.83, the high day close. It's the high day outside reversal close. Pay attention. Resistance still 42.09 to 42.19. Downside levels 41.50. Key support still 41.17 to 41.20. That tight zone right there. Questions on SPX? Okay, last but not least, Bitcoin. I just wanted to take a look at this because I, again, have been very impressed with how clean the technicals have continued to manifest. Here's the daily chart, guys. It's been very clean, right? The break below this zone, we talked about two levels, 32,000 and 30,655. Those caught the lows, right back at resistance, right back at support, right back at resistance. You're starting to see a little consolidation now, but guess where key resistance is? It's still right here. It's still right here. Right into 40,066, 40,929. 618 retracement of the yearly range. That's still a valid level. 200-day moving average. That's still a valid level. The median line for the current operative slope. That's right in there. And the high day close for January. Critical region. So while below 42, let's call it 41.92, yeah, I think there's a risk. I still think there's that risk. So trade accordingly. Use that for what it may. If you drill down deeper into the 2-hour charts, you see a very similar kind of scenario panning out where this could be a 1, 2, 3, and this could be one just contraction truncated 4, in which case below 4,200, 42,000 rather, you're still risking that last dip, that last crunch to a new low in Bitcoin. So Remains to be seen. The whole focus right now is on this recovery, inflection into 42,000. That's the level you need to breach. If that breaks, I think you're on the resumptive move for a larger rally in Bitcoin. But until you do, watch out. Okay, that's everything on my list. Let me know if you guys have any other questions or trade setups. I think the one I just missed from you, Marcin, which I see you're out of the room already, but Euro Kiwi. So, oh, wrong charts. Euro Kiwi is an interesting trade, but again, my concern is Kiwi. So for this trade, I'm actually looking for sort of exhaustion. Closer to the upper parallels would be the better play. So here's Euro Kiwi on the longer term charts. This is the daily. I love this slope. Now, ideally, resistance would have held basically right here. Okay, you have it's outside reversal close day, but it's also the objective 2018 open. Has been a major pivot in price for the last couple of years. Even if it gets a little higher, right? I'm essentially treating this still as the May opening range, which never broke. So that's all I'll say on that. A topside breach, you're clearly looking for a rally towards 72.45. A break below the 100-day moving average, a break below yearly slope support, a break below the median line, you're looking for 65.46. That's the former low day close from way back here in 2019. So again, a lot of ranges, but these ranges will clear, guys. I don't look at those pairs, Jamie, to be quite honest with you. I don't know if that's a typo. Are you talking about dollar mex? But yeah, the Monroe. Yeah, I don't follow it. I don't ever follow it. But Jamie, what I would say to you is this: keep in mind one thing, brother. Even if you have an opinion that you would want to reflect on a very ancillary, exotic market, um, the liquidity isn't necessarily there. So just from a professional trading standpoint, I try not to go into too much of the crazy exotics if I'm looking for a trade. Jamie, if you're looking for a position that you're going to hold for the next 6 months, next 3 months, that's fine. But the spreads are going to be bigger. The execution is not going to be as clear. It's not going to be as clean. It's not going to be as liquid. And I just tend to steer away from really exotic pairs like that. So remember, where our focus is technicals, right? Jamie, the pairs that have the more volume, any pair, whether this is FX or even stocks or anything that you're trading, the more participants, the more players involved, the more reliance you can put on the technicals. If you get into the really extreme, extraneous, exotic pairs, you're not going to see the technicals be as clean as manifested. So, um, just my point of view, you know what I mean? So that's a 38 too right there. You just tagged it. 100-day moving average hasn't closed above it yet. So also you're gonna watch that today on the close. And at first glance, it looks like you could say this was a near-term consolidation breakout, right? You got a series of lower highs, got a series of higher lows. But that's concerning near term. This is a major pivot in price. So let me just transfer that for you here. And let's just see, for Jamie's sake, if there's any slope to be had here. Yeah, it's a stretch. So you don't want to get too liberal with that, but I would have you at near-term resistance right now and resistance on momentum as well. So momentum's kind of pulling back. So I wouldn't be too surprised to see a pullback. Support I'd have somewhere around 276. Um, Anything below that would kind of like dissuade this entire rally, be in a bigger trouble. So Jamie, some color there. I'm always willing to look, brother, at any trade that you're looking at. More than happy to, but just not really my cup of tea in the really exotics. All right. So guys, we'll go ahead and wrap it up there. I want to thank you all for attending today's webinar. As always, we'll be back in the free session on Monday on Daily FX, and I'm right back here on Tuesday and Thursday next week. Um, Watch the NFP print tomorrow. Okay, it's expected to be quite a ripper because 650, if we do get it, would be a dramatic improvement from the previous month's read. But watch the headline unemployment rate and watch, more importantly, the labor force participation. And with regards to inflation, the average hourly earnings year on year, they were up 1.6% in May, which is actually pretty big. So if we see that inflation is being, corresponds to or alongside price inflation too, that might reduce some of the concerns. Um, but again, that all remains to be seen. So best of luck trading tomorrow into that event risk, and I will see you all on Monday. Have a great weekend. Jay, Jamie, March, and all everyone in the room. Same to you guys. Cheers.